You're watching episode 39 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning in to another episode of the Tax Smart Daily. I'm Brandon Hall, and before we get started, I invite you to join our Facebook group and our Tax Smart newsletter. Links to both of those are in the description of this video. Today's topic is about qualified non-recourse financing and how it gives you basis in partnerships to take good tax deductions. If you are a limited partner or if you're an investor and you invest in a real estate syndication, or if you're a general partner and you're structuring a real estate syndication, you need to know what qualified non-recourse financing is. It blows my mind how many CPAs, tax advisors, and attorneys do not understand what qualified non-recourse financing is and how to advise on it. When you buy a large apartment complex, you're typically going to get non-recourse financing from the bank. You might have to guarantee and then it becomes recourse, right? So non-recourse means that the bank can't come after you. Recourse means that the bank can look through the entity and come after you, whoever guaranteed the note. So typically on larger deals, we're going to see non-recourse financing. That's the norm. But when non-recourse financing is secured by real property, it's going to be considered qualified non-recourse financing. And for the purposes of the at-risk rules, which we're not going to go into, but for the purposes of the at-risk rules, it gives you basis in the entity to take tax deductions. Now, what does this mean? This means that if I'm a general partner in my LLC and I've raised $1 million from 10 investors, and we go out and we buy this $5 million apartment complex, I do a cost segregation study, I get bonus depreciation to the tune of $1 million. I now have $1 million of depreciation that's going to create a large tax loss for me. Maybe it creates a $700,000 tax loss after all my rental income and all my other expenses. So I've got 10 investors plus me. I'm the general partner. They're all limited partners. They're Class A. I'm Class B. I've got this LLC. We've got this $5 million apartment complex, and we have a $700,000 tax loss. The question is, who gets to take the tax loss? Now, first, we're going to go to our operating agreement. We're going to look at our allocations of losses, profits and losses. So you always have to go to the operating agreement. Do not let your CPA make the mistake of saying, well, just because you put zero money into the deal means that you get $0 of loss. That is not how this works. You go to the operating agreement to figure out where these losses, the $700,000 of loss, who that should be allocated to. Now, the mistake that I just mentioned, if I'm the general partner and I put $0 into the deal, my capital account in the entity is $0. Most CPAs look at that and say, your capital account can't go negative. That's what the operating agreement says. So unfortunately, we can't allocate any loss to you. But the reality is that as the general partner, I'm probably allocated some amount of that non-recourse debt, which I told you is qualified non-recourse debt, which means that I have basis to take losses. So let's say that I'm allocated $500,000 of the qualified non-recourse financing that the entity obtained for the $5 million property that it owned. If I put $0 into the deal, but if I have $500,000 of qualified non-recourse financing allocated to me, then I have a $500,000 adjusted capital account, even though on my K1 it's going to say $0. And that means that I can take up to a $500,000 tax loss if such loss is allocated to me. So don't make the mistake of simply just because I put $0 into the deal, I don't have basis to take the tax loss. That's where qualified non-recourse financing comes in. It can give you basis to take the tax loss for any sort of special depreciation that you're doing or anything in that deal. You always have to go look at that operating agreement to determine how the operating agreement is allocating profits and losses though. So make sure that you double check that. So qualified non-recourse financing, any non-recourse loan secured by real property, it's typically going to be allocated based on economic interest. And if I'm a general partner in the partnership, that means that I'm probably going to get some allocation of qualified non-recourse financing, which gives me basis to take tax losses that are allocated to me. I hope you enjoyed today's Tax Smart video. Follow us online. We've got a whole bunch of links to our social media network below in the description. And if you have any comments or if anything that I say resonated with you, please drop me a line below. I'd love to hear from you.